something remarkable is happening, and here's why it matters. The world's largest bank just admitted to a 4-hour loss, 8 billion silver trading loss, and instead of headlines screaming about financial catastrophe, you're hearing crickets. That silence? It's deliberate, it's calculated, and it tells you everything you need to know about how deep this actually goes. I've been watching precious metals markets for 17 years. I've seen flash crashes, manipulation scandals, regulatory hand slaps that amounted to nothing. But what's unfolding right now with JP Morgan and the silver market is not just another chapter in the same old story. This is different. The numbers are too big, the timing is too perfect. And the Federal Reserve's response, an emergency meeting called with less than 48 hours notice, that is the part that should have your full attention. Let me walk you through what's actually happening beneath the surface, because the mainstream financial press is either too compromised or too incompetent to connect these dots for you. JP Morgan Chase, the banking behemoth that manages over $3 trillion in assets, the institution that survived 2008 not just intact but stronger, has just disclosed a silver trading loss that exceeds the GDP of several small nations. $4.8 billion gone, evaporated in derivatives positions that apparently went catastrophically wrong. Now, before you dismiss this as just another trading loss in a world where banks gamble with house money and taxpayer backstops, understand what makes silver unique in the financial system. This isn't crude oil. It's not wheat futures or even gold. Silver occupies this strange dual role. It's both a monetary metal with thousands of years of history as money, and it's an industrial commodity that's absolutely critical for green energy, electronics, solar panels, and military applications. The global silver market is small. Shockingly small when you compare it to other commodities. The entire above-ground investment silver supply worldwide is worth maybe $40 billion at current prices. Read that again. The total investable silver on planet Earth is roughly 8 times what JP Morgan just lost in derivatives positions. Pay attention to this next part. JP Morgan has been the dominant player in silver derivatives for over a decade. They've paid fines totaling nearly $1 billion for spoofing and manipulation in precious metals markets. The Department of Justice literally prosecuted their traders. This isn't conspiracy theory. These are documented, admitted facts. JP Morgan traders were sending fake orders to move prices, accumulating positions at artificial lows, then canceling those orders after other traders took the bait. They got caught. They paid fines. And everyone assumed that was the end of it. But what if the manipulation never stopped? What if those fines were just the cost of doing business? And the real game continued in plain sight, just with slightly different tactics. Here's what we know from the Bank for International Settlements data. JP Morgan has been sitting on the largest concentrated short position in silver derivatives in the history of commodity markets. We're talking hundreds of millions of ounces in paper silver obligations. Contracts representing physical metal that may not actually exist in deliverable form. This strategy works brilliantly when you can suppress price indefinitely. You sell paper promises of silver you don't have, collect premiums, and as long as prices stay flat or decline, you profit. It's the ultimate control mechanism. You cap the price of a monetary metal that competes with your fiat currency system, you protect the dollar's perceived value, and you make billions doing it. Until you can't. Something broke in the silver market over the past 6 months. I'm watching the data daily, and the pattern is unmistakable. Physical silver premiums have decoupled from paper prices. You can see the spot price trading at $28 per ounce on the COMEX futures exchange. But try to actually buy significant quantities of physical silver, and you're paying $32, $33, sometimes more. That spread is the market screaming that paper and physical are no longer the same thing. Industrial buyers are getting nervous. Solar panel manufacturers need silver. Defense contractors need silver. They're securing long-term supply contracts at prices significantly above spot because they understand something that most retail investors don't. There's a physical shortage developing, while the paper market pretends everything is fine. This reveals something important. When you're JP Morgan and you've sold hundreds of millions of ounces of paper silver into the market to suppress prices, you're making an enormous bet that you'll never have to deliver physical metal. You're betting that traders will just roll their contracts forward or settle in cash. You're betting that the system maintains enough credibility that no one questions whether the metal actually exists. But then the delivery requests start increasing. Industrial users who can't afford supply disruptions start standing for delivery instead of rolling contracts. Other banks who see what's happening start requesting their allocated silver be physically segregated and audited. Suddenly, the game changes. JP Morgan finds itself in a position where they've sold claims on metal they don't have, and the people holding those claims are saying, "Show me the silver." The $4.8 billion loss? That's likely the cost of having to source physical metal at real market prices to cover positions they sold at suppressed prices. When you've shorted something for years at $20 and you suddenly need to buy it at $35 to deliver, those losses accumulate fast, especially when you're talking about hundreds of millions of ounces. Now, some of you might be thinking this sounds too big to be real. Too big to fail means they'll get bailed out, business as usual, nothing changes. And you're probably right about the bailout part. But you're wrong if you think nothing changes. Let's dig deeper. The Federal Reserve doesn't call emergency meetings for routine matters. They have scheduled FOMC meetings for a reason. When they deviate from that schedule, when they pull board members into urgent sessions with minimal public notice, it means something in the financial system is breaking in real time. The official narrative will say this meeting is about monitoring market conditions or assessing recent volatility in commodity markets. Watch the language they use. It'll be deliberately vague, but actions speak louder than words. If JP Morgan is facing a liquidity crisis because of silver positions, the Fed has limited options. They can't just print silver. It's not a financial instrument they can conjure with keyboard entries. It's a physical element with real supply constraints. This is why central banks hate gold and silver. These metals impose limits that fiat currency doesn't. The Fed could arrange a liquidity facility for JP Morgan, essentially loaning them dollars to buy silver at any price to cover their positions. This would work in the short term, but would send silver prices vertical, potentially triggering similar crises at other banks with short positions. Goldman Sachs and HSBC also have significant precious metals derivative books. Alternatively, they could try to orchestrate a coordinated takedown of the price using even more paper selling, trying to shake out weak hands and reduce delivery pressure. This is the usual playbook. But here's the problem. It's already not working. They've tried this multiple times in the last 4 months, and each time physical buyers just absorb the dip and demand more metal. I'm seeing reports from dealers that certain products are completely unavailable. Not delayed, unavailable. Major mints are rationing supply. These aren't signs of a liquid, healthy market. Here's why that matters. Silver's role in the financial system extends far beyond one bank's trading loss. It's a barometer for confidence in fiat currency. When silver starts moving independent of manipulation, when physical shortages become undeniable, it sends a signal that the paper manipulation game is ending. And if it ends in silver, what does that mean for gold? For the entire precious metals complex? For dollar confidence globally? This is significant. China and Russia have been accumulating gold for years, reducing dollar reserves, building alternative payment systems. The BRICS nations are discussing commodity-backed trade settlements. Saudi Arabia is now accepting yuan for oil. The petrodollar system that supported U.S. financial dominance since the 1970s is cracking. A silver shortage that breaks JP Morgan's derivatives book isn't just a banking story, it's a monetary system story. It's confirmation that the emperors have no clothes, that the paper promises vastly exceed the physical reality, and that when people start asking for actual delivery, the whole facade collapses. The timing here is not coincidental. We're watching Treasury yields spike because foreign buyers are backing away from U.S. debt. The Federal Reserve is trapped between inflation that's not actually defeated, despite the propaganda, and a banking system that's far more fragile than stress tests suggest. Regional banks are still sitting on massive unrealized losses in their bond portfolios. Commercial real estate is imploding. And now one of the supposedly safest, most sophisticated banks in the world is hemorrhaging billions on a commodity position that shouldn't have been possible if markets were actually free. Pay attention to this next part. The derivatives market in precious metals is estimated at somewhere between $500 billion to potentially over $1 trillion in notional value. These are paper contracts representing claims on physical metal. The actual physical metal available for delivery? A tiny fraction of those claims. This works fine until it doesn't. It's the banking equivalent of a game of musical chairs, where there are 100 people and 5 chairs. Everyone stays calm as long as the music keeps playing. But the moment someone gets nervous and makes a dash for a chair, everyone panics simultaneously. JP Morgan's loss suggests someone made a dash for the chairs. Someone demanded delivery at a scale that broke the model, and now the Fed is scrambling to figure out how to keep the music playing. I want you to consider what happens in the various scenarios from here, because each one has profound implications for your purchasing power and financial security. Scenario 1, the Fed successfully arranges a backstop for JP Morgan, floods them with liquidity, and they buy whatever silver they need at whatever price to close their positions. Silver spikes temporarily, maybe touches $45 or $50. Then they orchestrate a narrative about a bubble and crash it back down. This preserves the system short term, but accelerates the timeline for the next crisis because it proves bailouts are infinite and moral hazard doesn't exist. Scenario 2, JP Morgan's loss is just the first domino. Other banks have similar positions. As silver price rises to cover JP Morgan's shorts, it triggers margin calls and forced covering at other institutions. We get a true short squeeze where price goes parabolic. not to $50, but to $80, $100, potentially higher. This would represent a complete breakdown of the paper manipulation system. Physical metal becomes nearly impossible to source. Industrial supply chains face serious disruption. The Fed would likely attempt to orchestrate a force majeure, declaring a market emergency and allowing cash settlement of contracts that called for physical delivery. This would destroy what remains of commodity market credibility. Scenario 3. The emergency Fed meeting results in coordinated action with other central banks to flood the paper markets with short positions, trying to create a price collapse that scares people away from delivery requests. This is the standard playbook. The problem is China. If Western central banks collapse the paper price while China has been building industrial silver reserves, they'll just buy more physical at the artificial discount. This accelerates the wealth transfer from west to east and shortens the timeline to dollar replacement. None of these scenarios end with everything goes back to normal and nothing changes. That option isn't on the table anymore. The derivatives losses are real. The physical shortage is real. The confidence crisis is beginning. This reveals something important. Your financial security cannot depend on institutions that are playing with leverage ratios and derivative exposures that would make 2008 Lehman Brothers look conservative. JP Morgan isn't some reckless hedge fund. They're a systemically important financial institution with every regulatory advantage, every insider connection, every sophisticated risk model you can imagine, and they still managed to lose nearly $5 billion on a commodity that most people don't even think about. What does that tell you about the stability of the larger system? What does that tell you about the accuracy of the risk models? What does that tell you about the honesty of the regulators who supposedly monitor this? The mainstream media's silence on this story is perhaps the most telling element of all. When a major bank announces billions in losses, that's typically front-page news. Congressional hearings get scheduled. Financial pundits spend weeks analyzing what went wrong. We're getting none of that. A few brief mentions buried in the business section, framed as routine trading losses. Nothing to see here. Let me share a perspective that often gets overlooked. That coordination of silence requires either direct pressure or such complete capture of media by financial interests that editors instinctively know which stories to bury. Either explanation is damning. Meanwhile, if you're watching the actual silver market, spot prices, premiums, delivery times, mint production numbers, industrial demand data, you're seeing a completely different picture than the official narrative suggests. You're seeing tension building, cracks spreading, and increasingly desperate attempts to maintain the appearance of control. Let's dig deeper into what the emergency Fed meeting might actually accomplish, because understanding their limitations here is crucial. The Federal Reserve's power is ultimately based on their ability to create dollars from nothing. That power is immense in dollar-denominated financial markets. They can buy bonds, inject liquidity, backstop banks, manipulate interest rates. They've proven over and over they'll do whatever it takes to prevent dollar system collapse. But silver isn't a dollar-denominated promise. It's a physical element. The Fed cannot print it. They cannot will it into existence with accounting entries. Their influence over the silver market is entirely indirect. They can provide dollars to buy silver. They can support banks that are short silver. They can coordinate with other central banks to manipulate paper prices. But at the end of the day, if there are delivery demands that exceed available supply, no amount of Fed intervention solves that problem. This is why precious metals have been money for 5,000 years, and fiat currencies have a 100% failure rate over time. Reality always reasserts itself eventually. The emergency meeting will likely result in some form of liquidity support for JP Morgan. The Fed will characterize it as prudent risk management or maintaining financial stability. They might not even disclose the full details. Much of what the Fed does happens in shadows, in facilities with technical names that obscure their purpose. But providing liquidity doesn't solve JP Morgan's fundamental problem if the problem is physical delivery demands. It just lets them pay higher prices for metal that may not be available in the quantities they need. Here's what matters most. You're watching a live stress test of whether the paper derivative markets that govern commodity prices can survive a determined demand for physical delivery. For decades, the answer has been no. These markets control price through paper volume that dwarfs physical reality. A small group of banks with central bank coordination can essentially set the price of gold and silver regardless of actual supply and demand. But that control depends on public acceptance of paper claims as equivalent to physical metal. It depends on most traders preferring cash settlement. It depends on industrial users trusting that supply will be available when needed. Those dependencies are breaking down simultaneously. Retail investors are increasingly demanding physical over paper. Industrial users are securing supply outside the standard markets. Other nations are building stockpiles. And now JP Morgan's loss proves that even the most powerful players can get caught wrong-footed when the music stops. If you hold dollars in traditional banking institutions, you're exposed to this system. Your deposits are claims on a bank that's operating with leverage, investing in securities you don't control, with ultimate backing from a Federal Reserve that's already stretched thin. If you hold paper silver or gold through ETFs, you're trusting that the metal actually exists, is properly audited, and will be available if you want delivery. Given what we're learning about JP Morgan's positions, how much faith do you have in those assumptions? The case for holding physical precious metals stored in your possession or in truly allocated storage where you have direct title has never been stronger. Not because silver is going to make you rich overnight, though it might appreciate significantly, but because it is one of the few financial assets that does not depend on someone else's promise. When JP Morgan takes a $5 billion loss and the Fed calls emergency meetings, that's the system telling you promises are breaking. The sophisticated players who assured everyone they had risk under control are proving they don't. The regulators who claimed markets were well monitored and stable are proving they're either incompetent or captured. You don't need to predict exactly how this plays out to recognize that concentration in physical assets that can't be printed, can't be created with accounting fraud, and can't be devalued by central bank policy is rational risk management. I'm watching the overnight lending markets, the repo rates, the treasury auctions, and the actual physical precious metals flows. All of them are showing stress. Not crisis yet, but stress that's building. JP Morgan's silver loss is a symptom of that stress, not the disease itself. The disease is a global financial system built on exponentially growing debt, requiring constant expansion to avoid collapse, now hitting physical limits on multiple fronts. Energy costs, resource constraints, deglobalization, demographic decline in developed nations, loss of faith in institutions, these are all collision forces converging. Silver just happens to be where one of those collisions is occurring visibly right now. The same dynamics exist in gold, in treasury markets, in commercial real estate, in corporate debt markets. Everywhere you look, valuations and obligations that only make sense in a world of infinite growth and zero consequences. That world is ending. Not tomorrow, not in some dramatic single event necessarily, but in a series of breaks and failures and emergency interventions that gradually become the new normal until they can't hold it together anymore. Here's what matters most. Your job isn't to time the collapse perfectly. Your job is to position yourself so that when the promises break, you're holding reality. Physical assets, skills, communities, resources that have value independent of financial system functioning. JP Morgan's $4.8 billion silver loss is a warning. The emergency Fed meeting is confirmation that the warning is being taken seriously at the highest levels. What you do with that information determines whether you're protected or exposed when the next shoe drops, because it will drop. The only question is when and how many people will be paying attention before it does.